Welcome to the Deep Dive. Today we're digging into Rayonier's Q3 2025 results. They had their conference call back on November 6th.
Yeah, and for experienced investors watching RYN, this call was, well, it was probably one of the most critical in a long time. We're not just talking quarterly numbers here.
No, exactly. This feels like a real turning point for the company, doesn't it?
Absolutely, a fundamental inflection point.
You've got this radically different balance sheet after a big sale, this huge merger on the horizon.
And this whole narrative shift, right, towards being a delevered land infrastructure platform.
Right. So our mission today is really to unpack that because RYN smashed expectations. But the stock, well, it's still looking pretty weak long term.
That's the puzzle. There's a disconnect. So let's try to figure out what strategic stuff might still be making the market, a bit jittery.
Okay, let's start with that beat then, because they really did crush consensus for Q3.
Oh, absolutely. Pro forma EPS landed at $0.32. The FactSet consensus was way down at like $0.22.
Wow, that's a 45% beat? Huge.
Huge. And that's what gave the stock that little bump right after the call.
Then it wasn't just earnings per share, right? Revenue looks strong, too.
Yeah, revenue hit $177.5 million. That beat expectations by, somewhere between $15 and $17 million. But the real eye-popper, for me at least, was adjusted EBITDA.
Okay, lay it on us.
$114.3 million. Now compare that to the same quarter last year, $57.2 million.
Yeah, so they almost doubled adjusted EBITDA year over year.
Pretty much doubled it. Yeah. Monumental.
So where did that massive lift come from? Which part of the business?
It was overwhelmingly the real estate segment. I mean, that segment alone brought in $74 million of the $114 million total adjusted EBITDA.
74 million, okay.
Yeah. Now, they also had better execution in Southern Timber, which helped. But honestly, without that real estate surge, it's a totally different story for the quarter.
And I guess that helped paper over some cracks elsewhere.
Exactly. It helped offset the ongoing weakness in the Pacific Northwest timber segment. That part of the business is just, it's still struggling.
Okay, so real estate the hero. Let's talk about the underlying changes, though, because the financial transformation is really what feels new here. The catalyst was selling their stake in that New Zealand JV.
That's the one. Selling their 77% stake. That brought in about $710 million in cash.
700 million, correct.
And management, they didn't hang about. They used that cash immediately to basically perform surgery on the balance sheet. That's the big takeaway for you listening.
Right. So how different does it look now?
Night and day. Net debt was around $747 million at the end of 2024. Now, it's down to about $130 million.
Whoa. Okay, stop there. From almost $750 million down to $130 million.
Yeah.
That's not just trimming debt. That's transformative.
Completely transformative. Their net debt to enterprise value ratio, it drops to roughly 3%. 3%.
Goodness, that makes them one of the least leveraged players out there now, surely.
Absolutely, in the whole sector. And that financial firepower, well, it gave them options straight away.
Like returning cash to shareholders.
Exactly. They bought back over 1 million shares, cost about $30.1 million. And, crucially, they declared a special dividend, $1.40 per share.
Ah, yes, the special dividend. That's payable pretty soon, isn't it? December 12th.
That's right, funded by the NZ sale money. And notice the structure, 25% cash, 75% stock.
Which lets them meet their REIT obligations, but still keep plenty of financial flexibility, especially with that big merger coming up.
Precisely. Okay, so let's dive back into that real estate segment, the one that drove the Q3 beat. $74 million in adjusted EBITDA, you mentioned that. That's up $54 million from last year.
54 million year-over-year jump. Wow. And way above their own guidance, too, I assume.
Blew past prior guidance, yeah. The main thing was one absolutely massive deal.
Right.
A 21,600-acre conservation sale down in Florida.
21,000 acres. That's significant.
Huge. And management was clear this was non-strategic land. They got a really strong price for it. They framed it as like smart arbitrage, getting value way above what the market implies for just standing timberland.
Interesting. So not just selling land, but actively arbitraging it against its perceived timber value.
Exactly. And it wasn't just a one-off lucky break either. They also pointed to strong results from their improved development properties, Wildlight and Heartwood.
Right, those master planned communities.
Yeah. The ongoing work there on entitlements and infrastructure is basically setting the stage for years of selling that land for its highest and best use, not just as timberland.
Got it. Okay, let's shift to the core commodity business. Southern timber. How did that perform?
Southern Timber did well, $43 million in adjusted EBITDA, which was up 13% year over year.
13% up. Solid. What drove that?
Well, it's interesting, actually. The volume of timber they harvested was up 24%.
24%. Why such a big jump in volume?
Mostly better weather. It was drier, easier to log. Plus, demand for green logs got back to normal after all that salvage logging from storms kind of subsided.
Okay, so they pushed more volume through.
Right. And that higher volume was crucial because the price they got per unit, the net stumpage realization, actually fell by 5%.
Down 5% on price. Why the price pressure?
Soft pulpwood markets, that's the main culprit. You had some recent mill closures, plus still a bit of an overhang of supply from, earlier storm salvage efforts.
So good operational execution on volume basically offset weaker commodity pricing.
Perfectly put. They managed the controllables, the volume, very well. But pricing, that's still a structural headwind for them, no doubt.
Which unfortunately brings us to the Pacific Northwest, PNW Timber. Sounds like that was the weak spot.
Yeah, definitely the laggard. Only $6 million in EBITDA, and that was down $2 million from the year before.
Ouch. What went wrong there?
Two main things. First, harvest volumes dropped sharply down 34%. That was a direct result of them selling off some land up in Washington.
Okay, so lower asset base means lower volume. Makes sense.
Right. And second, they had some operational issues. Lumber recovery was slower than they expected, even though sort of paradoxically the actual log prices were a bit higher.
So a real mixed bag across the timber segments then. Massive real estate beat, solid southern volume, but P&W struggling.
Exactly. And that contrast, that internal mix shift, leads us straight into the really big strategic piece. That merger with PotlatchDeltic.
Right, the all-stock merger of equals they announced back in October. This thing is huge.
Absolutely massive. Creates a REIT with an enterprise value over $8 billion, over 4 million acres of land.
4 million acres. And the key number management is focused on
Synergies. They're targeting $40 million in run rate cost savings by the end of year 2 post-merger.
40 million. That's the benchmark the market's going to hold them to, isn't it?
Absolutely. That's the number to watch for judging if this deal truly works financially.
And the timeline for closing. Still looking like next year.
Yep, timeline seems firm. They're expecting late Q1 or maybe early Q2 2026. Still needs approvals, of course.
But there's a potential wrinkle, right?
Yeah.
I saw some sell-side notes questioning something about trade protection.
Yeah. That's a really interesting, nuanced point analysts are raising. Basically, both RYN and PotlatchDeltic currently benefit individually from things like higher duties on Canadian lumber and those Section 232 tariffs.
Okay.
The question is, when you combine two companies that both benefit from these protections, do you actually dilute that benefit? Does the combined larger entity become, less effective at capturing that edge, or maybe attract more regulatory attention?
So you gain scale and synergy, but potentially lose some of that concentrated trade protection advantage each had separately. That is a subtle risk.
It is. It's an efficiency gain potentially paired with losing a bit of your regulatory moat, if you like.
Interesting. But the strategic story they're telling isn't just about getting bigger in timber, is it? They kept talking about land-based solutions.
Yeah, they really hammered that theme. And this is where I think the long-term story gets really compelling, potentially.
Okay, so what does land-based solutions actually mean in practice?
It's about using their vast land holdings for things beyond just growing and cutting trees. Think utility-scale solar farms, carbon capture and storage CCS, carbon offsets, things like that.
Right. Higher value long-term uses.
Exactly. And they explicitly linked this to huge macro trends, particularly the enormous amount of capital flowing into AI and data center buildouts right now.
The power demand connection.
You got it. Those facilities need massive amounts of reliable, preferably renewable power. And RYN is sitting on this huge de-risked land base that could potentially host the solar farms or other infrastructure needed to power them.
So positioning their land as essential infrastructure for the digital economy.
That's the pitch. And they stress it's not just talk. They're actively doing the entitlement work, putting in infrastructure at places like Wildlight and Heartwood, specifically to enable this kind of, higher value monetization down the road.
It's like building a long-term hedge against the ups and downs of timber prices, using the land itself.
That's a good way to think about it. Okay, so given the strong Q3, they updated their full year guidance as well.
Let me guess, raised it.
Yep. Full-year adjusted EBITDA and pro forma EPS are now expected to be at or even above the high end of the previous ranges.
Okay, good news. But I bet the mix driving that has changed.
You betcha. The overall number is higher, but how they get there is different. Real estate guidance is now expected to exceed the prior high end.
Unsurprisingly.
Right, but Southern timber is now expected modestly below its prior range.
Because of those pulpwood prices.
Exactly. And P&W timber is now tracking near the low end of its range.
So it really crystallizes that story. The transformation, the real estate value, is funding and supporting the traditional commodity side through its weaker patches.
Perfectly summarized. Management was also pretty upfront about the headwinds facing the timber sector generally in 2025.
Yeah, what were the main ones they called out?
Well, U.S. housing starts haven't been great this year. Kind of underwhelming. Lumber prices remain soft, generally speaking. And those challenging pulpwood markets we talked about made worse by some recent mill closures.
Okay, so near-term challenges acknowledged. But what about the longer-term picture? Were they more optimistic there?
Much more optimistic about the long-term tailwinds. On the supply side, they pointed to the huge impact of the 2024 hurricanes, especially in the Georgia area.
The storm damage taking supply offline.
Significant supply. They cited estimates suggesting maybe 26 million tons of pine and 30 million tons of hardwood supply were affected just in that region.
Wow. It's got to tighten up the regional market for years to come.
So that's the expectation. Should provide a long tail of supply constraint. And then on the demand side, they see upside kicking in more in 2026.
From what specifically?
Those higher Canadian lumber duties potentially sticking, plus the new 10% Section 232 tariffs on softwood imports starting to bite.
Trade protection helping U.S. producers again.
Right. And beyond traditional lumber and paper, they're looking hard at alternative demand sources for pulpwood.
Like what?
Biofuels are a big one. They mentioned specific projects popping up in Louisiana and East Texas, apparently backed by major airlines looking for sustainable aviation fuel sources.
Interesting. Is that near-term potential?
They cautioned that the really large-scale biofuel projects are probably still like 5 years out from making a big impact.
Okay, so more of a medium-term kicker.
Yeah, but they're also looking at nearer-term stuff. Things like biochar, which can generate carbon dioxide removal credits, and renewed interest in exporting wood chips, maybe to Europe, potentially helped by some regulatory easing. That mentioned Port Savannah specifically.
So actively diversifying their customer base beyond just traditional paper and pulp mills.
Definitely. Trying to maximize the value of every ton, regardless of cycles in the traditional markets.
Okay, so let's pull back then. We've got this strong quarter, this transformed balance sheet, a huge merger pending, this pivot to land solutions. But the stock, it popped after the call, sure, but long-term it's still way down year over year, right? Underperforming the timber ETFs significantly.
Massively underperforming wood, yeah. And that's the core tension, the disconnect we talked about at the start.
So how do we explain it? The market sees the great numbers, especially from real estate.
Right, the results confirm real estate is the earnings engine right now. That should be good news.
Whoa.
But the market seems really cautious. I think investors worry about how lumpy and repeatable those big real estate sales are. Can they keep pulling rabbits out of the hat? And maybe more importantly, there's significant execution risk around integrating PotlatchDeltic.
The merger integration channel.
Yeah. Merging two companies this size is complex, making it work smoothly, actually achieving those $40 million synergies. That's tough. They've fixed the balance sheet, which is great. But now they have to prove they can execute this massive integration.
And that uncertainty, that execution risk, is probably what's keeping a lid on the stock price, despite the strong Q3.
I think that's exactly what's being priced in right now. That discount reflects the integration risk.
Okay, perfect setup for our final segment. This is not financial advice. Time to pitch a provocative, maybe slightly outrageous, but plausible trade idea based on everything we've just discussed. Something you could actually take to an investment committee.
All right, let's do it. Here's the thesis. Rayonier has fundamentally changed its spots. They took commodity risk timber price volatility and swapped it via the NZ sale for fortress balance sheet strength plus embedded growth options. Think solar, carbon storage, large-scale real estate development, real optionality.
Okay, I follow the setup. Transformation complete.
Right, but the market, it's still valuing RYM like it's just a discounted timber play, maybe with some lumpy land sales thrown in. It's completely ignoring, or at least heavily discounting, this transformation and the real value unlock potential in that huge land base, especially relative to its public market price. There's an arbitrage there, we think.
So the market hasn't caught up to the strategic reality yet. What's the trade then?
The trade is simple, long RYN.
Just long the stock.
Long the stock. You're betting that management successfully integrates PotlatchDeltic and actually delivers those $40 million in synergies. And critically, you're betting that they accelerate monetizing that pipeline of land-based solutions, the solar, the CCS, the development projects over the next, say, 2 years.
Okay, makes sense. But RYN is still exposed to timber prices and the housing cycle, right?
Yeah.
How do you manage that risk, which is clearly what the market is still worried about?
Good point. To hedge that residual timber and cyclical exposure, you pair the long RIM position with a short position against a different timber REIT. Specifically, pick one that's more of a pure play timber company, probably one with higher leverage, and crucially, one that lacks RYN's big real estate development pipeline and doesn't have this immediate massive M&A and integration catalyst.
So a pairs trade. Long the transformed RYN, short a more traditional higher risk timber peer.
Exactly. It isolates the bet on RYN's specific transformation and execution while hedging out some of the general sector risks.
And what are the near-term catalysts to watch this trade?
Immediate catalyst is that special dividend hitting accounts in December that's cash and stock reinforcing the return story. Then the big one is confirmation of the merger closing, expected Q1 or Q2 2026. Successful closing and early signs of smooth integration would be huge.
Okay, I like it. Long RYN, short Peerco. Betting on transformation, synergy execution, and land value unlock, hedged against the commodity cycle. That's a solid pitch capturing the whole story.
It forces you to believe management can deliver on what they've set up. They cleaned up the balance sheet. Now they have to execute on the merger synergies and the land infrastructure strategy to justify the move.
Excellent. All right, let's recap the core takeaways from today's deep dive. Rayonier delivered a massive Q3 beat, almost entirely thanks to a surge in real estate earnings,
which funded a dramatic deleveraging of the balance sheet following the NZ sale.
setting the stage for creating this enormous land platform through the pending merger with PotlatchDeltic.
Yep. Which brings us to the final provocative thought for you, our listeners, to chew on. Management has laid out the plan: $40 million in synergies, sustained real estate momentum, pivot to land infrastructure. If they execute, will that finally be enough to convince the market to stop viewing RYN as just another discounted timber REIT
and start valuing it as a higher multiple, more diversified land infrastructure compounder?
That's the multi-billion-dollar question, isn't it? Will the market finally buy the transformation story?
That question will likely define RYN's stock performance for the next couple of years. Thanks for joining us on this deep dive. We'll catch you next time.